Hi everyone, my name is Edi Sajuka.
My name is Yan Faisal.
My name is Rinaldi Aziz.
At this moment, we would like to share our review on corporate finance book with the title Lesson in Corporate Finance, which is written by Paul Esquisse and Lawrence Awis. This is very interesting book as assignment of corporate finance class from Professor Roy Sembo as our facilitator at IPMI International Business School. Please enjoy the video.
Now, I'm going to share about a part of this book. In this section, we will explore how a company chooses its capital structure, financing alternatives, and financial policies. The point is to find out the trade-offs between debt and equity financing, as well as their impact on financial decisions regarding the cost of capital. In the beginning, we can get into working capital management, emphasizing the importance of managing current assets and liability efficiency, complete with tools and techniques to optimize working capital to ensure liquidity and operational efficiency for the company. In the middle of this section, we will be able to study issues related to capital structure decisions and the trade-off involving the choice between financing using debt or equity. Here, will be discussed what impact it has on leverage in company risk and return profile. At the end of part 2, we can look at the principle of bond valuation and the factors that influence bond prices. The discussion will also cover valuation metrics such as yield to maturity and coupon rates to evaluate the attractiveness of bond investment. Let's start from the chapter Why Financing Matters, lesson from Massey Ferguson. Massey's product market strategy. Target market. Massey focused on smaller tractors and sold them to countries with small farms, primarily in Asia and Africa, avoiding direct competition with larger rivals in North America. The justification? The strategy allowed Massey to avoid direct competition with larger rivals like John Deere and International Harvester in North America, positioning itself in market with growth potential. Political risk and economies of scale in production. Production strategy. Massey concentrated production in high-cost countries and sales to developing countries was justified by the growth of agriculture in the developing world. And they're operating in more than 30 different countries around the world allow Massey to diversify its market presence. Sales growth. Massey achieved significant sales growth, averaging 20% a year during the 1971 until 1976 period, while trying to develop new markets. Massey's ROE averaged 12.7%, indicating good financial performance during the period. Massey debt financings. Debt level. Massey debt per total capital averaged 47% between 1971 until 1976, with the target debt ratio in the range of 41 until 51%. Comparison with competitor, Massey debt level was higher than its major competitor, John Deere, which had a debt level of 31.37% in 1976. Aligning financial strategy with product market strategy. The importance, the significance of aligning financial strategy with product market strategy to mitigate risk and support growth initiatives. And lesson from Massey, understanding the industry and the firm products market before deciding on its financing. Impact of financial distress. The long-run competitive prospect of a firm are the primary cause of financial distress, and Financing policy can become a strategic weapon affecting a firm's cost of capital and its ability to respond in periods of market turmoil. Matching business strategy to financing policy. The importance of understanding the industry and the firm's product market before deciding on its financing to optimal capital structure. The significance of long-term fixed rate debt to avoid refinancing in economic downturn, its debt maturity and the interest rate. It can be too late to unlever. Firms with high debt ratio can spiral down quickly, precluding them from issuing new long-term debt financing or equity due to the debt overhang. The cause of financial distress is financial distress lead to Messi permanently losing market share to competitors, impacting its long-term competitive prospect. The impact of financial distress on a firm's ability to respond in periods of market turmoil or downturn.
After we learned about Messi case, about the understanding of the industry and the firm product market before deciding on its financing, now we are going to learn about investment decision in a company. When the company is going to do an investment, they need to know what is the factors to be considered to decide whether it is good or bad investment. In order to that, we must learn time value of money. Taking an amount today and computing what is worth in the future is called compounding. Taking an amount in the future and figuring out what it is worth today is called discounting. Compounding and discounting are inverses of each other. This compounding of a present value into future value is a concept familiar to most. We encounter this regularly when we put money in the bank and collect interest. Discounting a future value to a present value is usually new to those not familiar with finance. It is, however, as noted above, the inverse of the compounding. Mathematically, it works as follows. If you invest $100 in a bank account at the start of the year and earn 5% annual interest on your funds during the course of the year, how much will you have at the end of the year? You will have $105, which is your original deposit of $100 plus the interest of $5 that you earned during the year. This means that with an interest rate of 5%, $100 today is equivalent to $105 in a year. In discounting, we look from a different side, where if our money become $105 in a year, how much is the value today with a 5% annual interest? It will be $100 today. For net present value, in finance, investment decisions are often expressed in terms of net present values. So what is a net present values? It is the present value of all investments cash flows, including both inflows and outflows. Normally, investment require initial payment, followed by a series of returns. If the NPV is positive, it is considered a good investment. If NPV is negative, it is considered as a bad investment. A $0 NPV does not mean the investment does not earn a return. Rather, it means that the investment earns a competitive return, one of that can be obtained elsewhere. If the interest rate truly is 5%, investing $100 today to receive $105 in a year is neither a good investment nor a bad investment. It is a fair return. The investor earns 5% and has an NPV of $0. So NPV is used as an investment decision rule as follows. A positive NPV means that the future returns on investment are greater than the risk of investment assumes. A negative NPV means that the future returns on the investment are less than the risk the investment assumes. Note that a negative NPV does not mean the total future cash flow are less than the initial investment. It simply means that the future cash flows are not high enough to justify the initial investment given that required return. Thus, we can say that NPV more than $0, good investment, NPV below $0, bad investment, and NPV equal to $0 investment earns a competitive return. Other than NPV, a company can use internal rate of return or IRR for analyzing capital budgeting projects to understand and compare potential rates of annual return over time. The internal rate of return is the annual rate of growth that an investment is expected to generate. IRR is calculated using the same concept as net present value, except it sets the NPV equal to 0. The ultimate goal of IRR is to identify the rate of discount, which makes the present value of the sum annual nominal cash inflows equal to the initial net cash outlay for the investment. Keep in mind that IRR is not the actual dollar value of the project. It is the annual return that makes the NPV equal to 0. If the IRR is greater than the firm's required return, then it's a good project. If the IRR is less than the required return, then it is a bad project. If the IRR equals to the required return, the investment earns a competitive return.
If we talk about payback, as long as we are dealing with investment rules, we should also mention payback. Even though not used by many firms today, in the past, this was a popular technique for evaluating investment projects. It is still used by many households and individuals when considering personal investment. Payback evaluates a project by measuring the time until the initial investment in the project is repaid. The rule is to choose whichever project has the shorter payback. And then we talk about the weighted average cost of capital. A company needs to know what is the average rate that a company expects to pay to finance its business. To answer this question, we must discount the cash flows. And to do what we need a discount rate. Cash flow just to equity are discounted at the cost of equity, and cash flow to debt are discounted at the cost of debt. However, when using the cash flow to the firm, the discount rate is the blended cost of debt and cost of equity. This blended rate is called the weighted average cost of capital, or WACC. Weighted average cost of capital represent a company average after tax cost of capital from all sources, including common stock, preferred stock, bond, and other form of debt. WACC is a common way to determine required rate of return, or RRR, because it expresses in a single number the return that bondholders and shareholders demand to provide the company with capital. A company's weighted average cost of capital is likely to be higher if its stock is relatively volatile or if its debt is seen as risky, because investors will want greater returns to compensate them. When we talk about the capital asset pricing model, to calculate the expected rate of return for an asset or investment, the company can use the capital asset pricing model. Capital asset pricing model is based on the relationship between an asset beta, the risk-free rate, typically the treasury bill rate, and the equity risk premium, or the expected return on the market minus the risk-free rate. It is a finance model that establishes a linear relationship between the required return on an investment and risk. This allows for easy comparison of investment alternatives. CAPM evolved as a way to measure the systematic risk. It is widely used throughout finance for pricing risky securities and generating expected return for assets, given the risk of those assets and cost of capital. In summary, This book structured around real-world decisions that a chief financial officer or CFO must make. How firms obtain and use capital. The primary function of corporate finance can be categorized into three main tasks. The first one, how to make good investment decision. Secondly, how to make good financing decision. And the third one, how to manage the firm cash flow while doing the first two. Hopefully this video is useful for you.
Thank you for watching.